You know, investing can feel like this secret world, right? Like it's only for the experts. But what if I told you that long-term success isn't about some secret Wall Street tip, but about mastering four simple, really powerful principles? Today, we're going to break those four pillars down to build a solid foundation for your financial future. Let's dive in. Albert Einstein, yeah, that guy. He wasn't just a genius with physics, he totally got the almost magical power of compounding. And look, this isn't some exclusive club. It's a force that's available to every single one of us. It's where your money starts making money, and then, get this, the money that money makes also starts making money. It is the definition of a snowball effect for your wealth. So, okay, if the main idea is that simple, why does it feel so overwhelming for so many of us? Well, we are just bombarded 24/7 with financial news, market predictions, endless options. It's just noise. And there's this constant fear of messing up. Buying at the very top or selling at the absolute bottom. It can feel like this high-stakes game where only the pros can ever win. But here's the real secret. The key to all of this is learning to tune out that noise. You can't control what the market's going to do tomorrow. Nobody can. But you can absolutely 100% control your own actions. Success really just hinges on a few core principles that are totally within your grasp. So let's break them down one by one. All right, first up, pillar one, define clear goals. Think of this as your compass. Without a destination, you're just kind of drifting, right? A real investment plan isn't about picking hot stocks. It's about figuring out what you want your money to actually do for you. So what are we talking about? What are those goals? Maybe it's a retirement where you don't have to worry, or a down payment on a house, or maybe it's just building a safety net for your family. Getting really specific about these goals gives every single dollar you save a clear purpose. It becomes the why behind everything else. And check this out. This visual shows something incredible about how this works over time. In the beginning, yeah, your savings are doing all the heavy lifting. But look what happens over a 30-year horizon. Your investment returns grow to become nearly half of your total wealth. Your money literally starts working just as hard as you do. It's amazing. This little story perfectly shows why starting early is your absolute superpower. So meet Maria and Anna. They both invest the exact same total amount of money, 30 grand. The only difference? Maria started 10 years earlier. Thanks to the power of compounding over that extra decade, she ends up with about $120,000 more. Time is, without a doubt, the most valuable asset you have. Okay, on to pillar two, balance and diversify. So once you know your destination, you need a blueprint for the vehicle that's going to get you there. This is all about building a portfolio and diversifying your holdings to match your goals and, this part is crucial, your personal comfort level with risk. This chart basically shows you the fundamental trade-off in all of investing. See how as you add more stocks, your potential average returns go up? That's great. But also notice how the range of outcomes, the volatility, the crazy swings, also gets way wider. Finding the right asset allocation is all about finding that sweet spot on the spectrum where you can still sleep at night while making good progress towards your goal. So which asset class is the winner? Look at this chart. It's a total mess, right? What was hot last year is often at the bottom the next. It's pretty much impossible to consistently predict the top performer. And that is exactly why you do not put all your eggs in one basket. Diversification smooths out the ride by making sure you always have a piece of the action, wherever the growth happens to be. All right, pillar three. This is the one that so many people overlook. Minimize costs. Look, market returns are always going to be uncertain, but you know what's a certainty? Fees. They are a constant, invisible headwind blowing against your portfolio. The good news? They are one of the few things that are 100% in your control. Now, this might be the most counterintuitive rule in all of finance. In pretty much every other part of life, a higher price usually means higher quality. But in the world of investing, the opposite is often true. Every single dollar you pay in fees is a dollar that isn't working and compounding for your future. Let's see just how big an impact this makes. Imagine two identical portfolios, both starting with 100 grand. One has really low fees, the other has pretty high fees. Over 30 years, how much of a difference could it really make? Yeah, over $240,000. That is $250,000 of your money gone, just vanished into high fees. This is why keeping costs low isn't just a minor tweak, it is an absolute cornerstone of your success. And that brings us to our final pillar, pillar 4. And honestly, this might be the toughest one of all. Stay disciplined. This isn't really about finance, it's about psychology. It's about having a plan and actually sticking to it, especially when your own emotions, fear and greed, are screaming at you to do the exact opposite. It is so tempting to try and jump out of the market when things get scary and then jump back in when it feels safe again. But this data shows why that's so dangerous. Missing just the 10 best trading days in a single year can absolutely crush your returns. And here's the crazy part. The market's best days often happen right after its worst days, which makes timing them correctly pretty much impossible. This classic quote just says it all, doesn't it? The goal isn't to be a market psychic, it's to be a long-term participant, giving your diversified, low-cost portfolio the time it needs to grow through all the market's ups and downs. You know, when Warren Buffett says never lose money, he's not talking about avoiding the normal ups and downs of the market. What he's really talking about is the discipline to avoid making those impulsive, emotional decisions that lead to a permanent loss of your hard-earned capital. It's about protecting yourself from your own worst instincts. Think of it this way. Your rational, well-thought-out plan is your best defense against your emotional, kind of primal brain. When panic sets in, that plan is your anchor. It reminds you why you started this in the first place, and it keeps you from selling at the absolute worst possible moment. So there you have it, the 4 pillars of investing success. See, they're not secrets, and they're not that complex. Number 1, define your goals so you know your destination. 2, build a balanced portfolio to be your vehicle. 3, minimize costs to reduce that headwind. And 4, stay disciplined to stick to the plan no matter what. These principles puts you in the driver's seat of your own financial journey. They're simple to understand, but they are incredibly powerful when you apply them consistently over time. So the only question left really is, what's your first step going to be? Thanks for tuning in.